Friday, July 7th, 2023, Monaco 64, home of alternative economics and contrarian views. We're going to look at how well the economy is really doing today. Of course, we've got the U.S. jobs data today. It's out at 8:30 a.m. Eastern Time or 1:30 p.m. London time. It's always been a very important number or statistic for the markets. I remember well back in the 90s when I was still working in this city. Even back then, it was important. I think prior to that number, it was the trade deficit numbers that were important in the mid to late 80s. And before I start, though, I'd like to say that the major problem for the whole Western world, and the U.S. in particular, because the U.S. is the leader, not just of the Western world, but the whole world at the moment, is the debt. And that's something that they don't want you to focus on. But I think it's really worrying, especially with the way the trajectory of interest rates right now and bond yields as well. I don't think central banks are anywhere near neutralizing inflationary pressures because they've left it for too long to fight the inflation. And again, in my opinion, central banks like inflation, but what they don't like is when prices get out of control, especially consumer prices. They're fine with real estate, stock market, private equity bubbles. They're fine with that as long as they can keep consumer prices rising, maybe just at 2%. But now it's getting out of hand and the general public is waking up. So yeah, the debt is really important. So when you look at the U.S. debt clock now, we're almost at $32.5 trillion. That's just the national debt. There is, of course, more debt, household debt, corporate debt. I'm not even looking into that. There's unfunded liabilities, of course. That's up to 192 trillion. And the baby boomers are retiring en masse, not just in the US, but here in the UK as well. And there's less and less people working to finance that system. So right now we're at 122% of GDP. And in the US debt clock website, you can go in the time machine, and I'm going to check out 2027. And these are from the Congressional Budget Office forecasts. And it's telling me now that the debt in 2027, the national debt will be at 43.3 trillion and almost 150% of GDP. I think that's the thing that we need to keep in mind as we go forward about the economy, about the currency. And of course, a lot of Americans don't really think of the currency that much because the dollar has always been the major reserve currency, or at least since the post-war period. So Americans don't care about foreign exchange rates as much as people all around the world do, especially in emerging market countries. But I think it's something that we need to really focus on these days. And I think what the central banks and governments are going to try to keep doing is inflating, but they just want to get the consumer prices a bit further down and keep inflating at 2, 3, or even 4%. And it's, of course, it's going to be much more than that because they've tinkered so much with the numbers. So that's the thing that I think we need to focus on going forward, longer term. And why would you need to focus on these things? Well, because I think it's important for everyone, even if they don't work in the markets or trade, but if they're starting out, if they have a small business or a big business, if they're going to retire, I think we need to keep in mind these things, that the currency is going to continue to be debased, that we need to be careful. We need to hold hard assets to protect our savings. And always have in mind that the central banks and the government are not they're not there to look after your interests. So is the economy doing really well? We had some economic data yesterday, and of course we have the non-farm payroll today, but usually the day before non-farm payroll, you have this ADP non-farm employment, and that jumped massively. It was 267,000 the previous month, and it jumped to almost 500,000. The number was expected at 228,000. And that led to a jump in bond yields. It looks like the Federal Reserve will definitely hike now. At the end of July, they'll have to raise interest rates after the pause. And don't you think it's weird, though, and ironic that an economy that's creating jobs, an economy that's supposedly seeing rising wages and profits, corporate profits going up, why would that be a bad thing? Because the more jobs there are out there, the more people are producing. And you think, well, they're telling us something that doesn't make sense. How can a growing, supposedly, economy with more people working be inflationary? Well, it's because they need to cover up the fact that they're the ones who create the inflation with the printing of funny money, which they have done. The Fed's printed over 8 trillion out of thin air since '08. The ECB about the same, and so on, and yeah, so it makes you wonder: are these jobs really real? Can you trust the statistics? I think there's a lot of that. But the other thing as well is that maybe some people are having to take on more than one job because they're struggling. And you can see that from data that I found here. And this is from March this year, and it's from bankrate.com. It makes you wonder if the economy is doing so well, if Bidenomics is the new thing. How come most Americans don't have enough emergency savings despite the strong job market? So it says here, do you have enough money saved to weather an unexpected job loss? If you're an adult in the US, your answer is likely no. More than 2/3 of Americans, or 68%, say they are worried they wouldn't be able to cover their living expenses for just 1 month if they lost their primary source of income tomorrow, according to a recent Bankrate survey. So maybe a lot of these people are thinking, I need another job because if I lose this one, I won't be able to survive. And maybe that's why a lot of the jobs are being created, and they're not really well-paying jobs, and they're not really productive for the economy. The finding comes when the job market is still punching above its weight. Employers added 311,000 jobs to the U.S. economy in February, and the unemployment rate ticked up slightly to 3.6% from 3.4%. Still an exceptionally low level. Inflation has been slowly coming down in recent months too. The thing about that unemployment rate is that it doesn't count a lot of the people that have given up looking for a job. So it would be a lot higher, I would add to that. But the hot job market could cool significantly this year amid the Federal Reserve's inflation fighting campaign. I laugh because they're not fighting inflation. They're just pretending they're fighting inflation. The Fed predicts unemployment to rise to 4.5% by the end of 2023 as it continues to raise rates to rein in stubborn inflation. So here's some interesting facts. And I'm gonna put a link to this article below in the description. You can read the whole thing. Half of Americans are struggling to save despite the strong job market. 49% of Americans have less or no savings than a year ago. And only 43% said they could cover an emergency of $1,000 or more using funds from their savings accounts. Here's another anecdotal evidence that things are not as great as we're told. This is from Zero Hedge. It came out yesterday and it says, something just snapped. Consumers panic search pawn shop near me. So there you go. Just wanted to let you know about this, and I'm going to put a link to this short article below in the description as well. I don't think things are as good as the mainstream and Wall Street and the politicians make it sound. And why do I always go on about this? Well, because it's misinformation, and it can hurt people. It can lead them to think, oh, everything is great, I'm going to start this business or do this and that. And I think we need to be more discerning and do our own research and look at things, and not be dependent on what we're told by the powers that be. So the non-farm payroll is out later on today. I think it's expected to, let's have a look here. We're expected to have 225,000 non-farm payroll jobs created versus 339 last. So that's one number that you need to focus on. The other one for the Fed is the average hourly earnings because for some reason central bankers, it's just taking the spotlight from themselves. They say that higher wages create inflation, which is a load of baloney, but that one's important to look at. Is expected to be 4.2% from 4.3 year on year. And the other one that's could be important is the average weekly hours. It's expected to stay unchanged at 34.3. But if that number goes down, it means that the job market isn't that great. And looking at the chart here of average weekly hours, it's actually been trending lower since around the beginning of 2021. So that's also a sign that people are not working as much and the economy is not doing as well. So with that, let's quickly look at where the markets are this morning. It's 8:32 a.m. London time. So we've got gold, spot gold, up $5 at 1915.80. The high's been 1916, so we're near the highs. The low's been 1909.30. Silver's up 4 cents at 22.75. High's been 78, low is 60. Yeah, the stock market didn't do well yesterday. Normally you'd think, well, if employment is doing really well, the economy is doing well, how come the stock market dropped like 1%? Like the Dow dropped 360 points, NASDAQ 120. Well, it's because basically the market now sees that the Fed is probably going to keep raising rates. And the other thing about the yield curve is heavily inverted. And they said that back in 2019 when it was inverted. Oh, this time it's different. It's not a sign of a recession. But I think something's going to crack in terms of the economy. They won't be able to hold this rosy picture for very much longer. But this morning, though, the Dow futures continuing to go down. It's down 35 points. NASDAQ 100 futures down 33 and the S&P is down 6. To the currencies, sterling is unchanged, 127.40. The euro is down slightly at 108.85. The dollar is down 0.5% versus the yen at 143.23. And the dollar is unchanged versus the yuan at 725.40. Aussie dollar is unchanged, 66.30. Dollars unchanged versus the Canadian dollar at 133.72. And the Kiwi dollar is up 1/4%, 61.70. To the commodities, we got WTI crude up 2/3% at 72.22. Brent is up the same percentage, and it's at 76.90. Platinum is up $3, trading around 908, and high grade copper is up 0.2 at 374.28. Let's quickly check the bond markets. We'll start with the UK gilt market. We've got the 2-year gilt yield trading around 550. I think yesterday we got to around 556. So yields are continuing to creep up. We've also seen the 10-year yield now break through the highs from last September, October, when we had the gilt crisis and when the sterling dropped to almost 1-to-1 versus the dollar. So we're now at around 470. The gilt yield is at 468.35, and yesterday the 10-year yield, not surprisingly, rose above that 4% level that I was talking about. Right now at 403, it's down 1.3 basis points. So a lot of these numbers and prices could change significantly in a few hours with the non-farm payroll numbers. And longer term, though, what do I think? Well, I think the move away from paper assets, not completely, but a small percentage into hard assets is going to continue. And that's what I'm focusing on in the long term. So there you go. With that, I'm going to wish you all a very good day and a very good weekend. Take care. Bye.